spend Memorial Day at the beach house. I promise. I won't be renting it out this year. I'm actually making some renovations. Of course you can bring whiskers. I love you too. Seems like you've been spending quite some time at this beach house. Yeah? And you let your cousin stay there in spring break for $50? Yes, I did. Are you sure it's not your primary residence? Yes, I've been keeping track of my fair rental days and personal use days. How do you know about fair rental days? I saw a video about it on Airbnb. Oh well, carry on then. Taxes are an inevitable part of life, and today we'll be talking about fair rental days. Yes, I know this might sound like tax jargon, but I promise you, understanding this concept will make the difference between maximizing your tax deductions and possibly facing a dreaded IRS audit. Fair rental days are a way for the IRS to decide if your property is mainly a business rental or your personal home. Fair rental days are the days that you rent out your property at normal market rates, basically what others in your area are charging. So if grandma stays for free, or if your cousin only pays $50 and you charge $150 per night, that does not count as fair rental days. Those would be classified as personal use days. This concept is especially relevant for Airbnb or vacation rentals, but it applies to long-term rentals as well. When filing your taxes using Schedule E, which reports rental income and expenses, it's important to identify fair rental days versus personal use days. This distinction affects how much property expenses you can deduct from your rental income. To qualify as a business rental and not as a personal home, your personal use days should be minimal, no more than 14 days per year, or 10% of the total days that the property is rented out at market rates. So for example, if you rent out your home for 150 fair rental days, you can only use it for personal purposes for up to 15 days a year. If you go beyond that, the IRS might classify your home as a personal property, and you could lose out on claiming many rental expense deductions. Not to mention you could be facing penalties or even a full-scale IRS audit. However, if you rent out your property for 14 days a year or less, the income you earn is entirely tax-free, and you don't need to report it. Tracking fair rental days can have many benefits. Not only is it important to stay compliant, but also to save money on your taxes. The IRS looks at how many days your property is rented at normal market rates to decide how much of your property costs, like repairs, utilities, and property taxes, you can write off. For example, if you rent out your home for 100 days, with 50 days at fair market value and 50 days for personal use, then only 50% of your expenses can be deducted. Balancing fair rental days and personal use days helps you maximize your income and deductions, making your rental more profitable and less stressful during tax time. The more fair rental days you have, the more expenses you can write off. But watch out. If you wrongly count personal days as rental days or forget to track your usage, it could lead to penalties or an audit by the IRS. Also keep in mind that if you rent out your place for more than 14 days in a year, you have to report all rental income and carefully track your rental versus personal use days. If your personal use exceeds 10% of your total rental days, you might not be able to claim rental expenses at all. So good tracking is key to staying compliant and saving on taxes. Now, how do you ensure you're IRS compliant? Here are some practical tips. Use Airbnb's booking calendar to carefully track reservations. Keep a spreadsheet to manage guest stays and calculate fair rental days. And if you want to simplify things, consider using software like Uplisting to organize bookings across multiple platforms and manage fair rental days efficiently. Okay, but what happens if you rent out your primary residence or if you only rent out a part of it, like individual bedrooms? For your personal home, you might consider renting it out for 14 days or less out of the year to maximize your tax-free rental income. These can be useful during special events or holidays. For example, in many college towns, homes become available exclusively during graduation weekends. And during last year's eclipse, many people in the path of totality rented out their homes during the days surrounding the celestial event. Now, if you only rent a part of your home, like a single room, fair rental days are calculated slightly different. Since the property is shared between personal and rental use, the IRS allows you to prorate deductions based on the percentage of the home used for business purposes and the number of fair rental days. I know it sounds complicated, but let's say your house is 2,000 square feet and you rent out a 200 square foot room. That would be 10% of your home expenses. However, you still need to keep track of fair rental days and personal use days to figure out your deductions. Taxes may not be fun to deal with, but knowing how to handle your rental days can save you money. Your tax deductions depend on the amount of fair rental days you have compared to personal use days. keep detailed records of both and avoid common mistakes like misclassifying personal days. Using the property yourself or renting it out to family at a discount counts as personal use. Track these days carefully because they affect your deductions. Renting to your family below market value. Even if done with good intentions, this can affect your ability to claim deductions. Not keeping good records. Save receipts, booking info, and calendars showing when you rented the property and when you used it yourself. Remember, if you rent out your property for less than 14 days each year, the income is tax-free. You don't need to report it. But if you rent it out for more than 14 days, you can still qualify as a rental property if your personal use doesn't go over 14 days or 10% of the days you rented it at fair market value. Now, how do we find fair market rental value? This is what someone would reasonably pay to rent your property. To figure it out, you can compare similar properties in your area. Be sure to consider location, size, amenities, and the season. And of course, you can use Airbnb's tools to see average rental rates and market trends, helping you set a competitive price and stay compliant with IRS rules. Before jumping into hosting or adding another property to your portfolio, consider the impact of fair rental days. Ask yourself, how often will you use the house personally? What's the fair market value in the area you want to invest in? Can you achieve your financial goals while staying compliant? Want to maximize your income without crossing into personal use territory? Then consider these tips. Align your availability with high demand periods. Encourage longer-term bookings during off-seasons. Adjust pricing to stay competitive yet meet IRS compliance. And there you have it. The roadmap to mastering your fair rental days and ensuring your Airbnb experience is both lucrative and legally sound. And by following these helpful tips, you can be sure to keep those IRS audits at bay. What? I said someone's evading taxes by the bay? Not on my watch. If you found this video helpful, give us a thumbs up and subscribe for more hosting insights. Have more questions about fair rental days? Let us know in the comments below. We love hearing from you. Thanks for watching and happy hosting. See you next time.